Okay, we are live. Matt, we got to choose different music. I realized about 3.5 minutes into that, I was like, oh my gosh, we need a different song. This is horrific. So, no, but everybody, this is Matthew Schultz and CEO and Chairman of CleanSpark. Thank you so much for taking time today. I know I said that beforehand, but I really appreciate it. Your time is precious. You're literally running a massive company and you're taking time for these opportunities to talk to retail shareholders. So, thank you so much.
No, it's my pleasure. I think we always appreciate the opportunity to chat, and the schedule just so happened to work out that this worked perfectly for both of us. And as far as the music goes, I'm now blissfully in a Zen state, so we're good.
Dude, it was so bad. Like it repeated so many times. I was like, oh my gosh. But yeah, no, absolutely. I think one thing too, like even looking at the mining space overall, one thing that was interesting, and I was thinking about now, this will segue starting into it, but I'm sure you know about this, but like Bitwise, they did a ETF that included like all of the Bitcoin Treasury plays and then the miners. And I remember somebody asked in the comments, they were like, hey, could you make an ETF and remove the miners because they're unloved in comparison to the Treasury companies? And now we're seeing the narrative switch. And what's really interesting, and I'll say this and kind of move over into you guys doing the HPC and AI, but as we've seen the switch, people are asking the question, how can you accumulate the underlying asset in an accretive way? Because we're seeing ATM offerings, super debt go out there. And it's like, okay, well, you guys, if you're not at a positive MNAV, you have no business. And so what are you actually doing to accumulate? And so this kind of goes into, what I was going to ask you guys. You guys are doing Bitcoin mining. In addition, you also have BTC reserves, and then you have AI compute and HPC. And so like when you guys are looking at what you guys are doing, how do you think retail investors should value you guys as you're kind of across the board?
So that's a loaded question.
Okay, sorry.
I think fairly Bitcoin miners have been under pressure because the vast majority of the industrial scale Bitcoin miners don't do so profitably. And so they become a dilution machine or buried in debt. And we're not so far removed from the FTX and Three Arrows of the world that we've forgotten what disciplined capital stewardship looks like. So our approach has been different. I was on a panel in 2020, and there were miners that were taking shots at us that, oh, this is just a silly little energy company that they're trying to pivot into Bitcoin mining. And contrary to that, we hosted a day in Georgia, and Axios sent a journalist out, and he wasn't necessarily pro Bitcoin at all, but he wrote in his article back then that while the majority of the miners are Bitcoin bros trying to figure out energy markets, CleanSpark is comprised of energy professionals iterating. So we've kind of taken a counter-cyclical approach to everything we've done. In 2020, when everybody was FOMOing into miners at $90 or $100 a terahash, we were buying infrastructure and land. We were developing relationships with utilities. And then when the I guess enthusiasm and the froth started to pull back, Bitmain had launched at the time the S19 XP, and we were chastised by a lot of our shareholders because the 900-pound gorillas in the room, Marathon and Riot, were making billion-dollar orders. But the challenge is back then it was $500 million down and delivery in 12 months, or you don't get on the list and you're paying $80, $90 a T. So we waited. And, as the market evolved, companies like Stronghold and Greenwich and Argo, they had made the same deposits and made massive orders, only the market had shifted. And so when it came time to deliver those machines, they didn't have the ability to make those acquisitions. So we stepped in and picked up those same machines on the same delivery schedule at $16 a T and not 90 a T. Wow. So we've operated counter-cyclically. So our focus initially was infrastructure first. And, I was on panels when we bought a facility in Washington, Georgia. And one of the other CEOs said, well, the only M&A that's being done are on facilities that should have never been built in the first place. Well, that facility is now 86 megawatts. It's supporting a community, making a meaningful impact and allowing me to mine a couple of Bitcoin every day at a 54% gross margin. So, I guess maybe it should have been done. So, land and power, realistically, it's fundamental to everything we do. We have over a gigawatt of operating power right now and more than double that in our pipeline. We're looking to accelerate use cases. So when you say pivot, I'm going to use that carefully because we're not, we're Bitcoin maxis. You and I both talked about this before we started. We believe in the value of Bitcoin and the libertarian principles and how it represents freedom. I'm just like you. I feel like there's a national security risk. I talked about that on Twitter earlier after having spent a week in Washington, D.C. and then some time in New York with some policymakers and former president and then hosting an event in Nashville with Bitcoin Park. I really feel like securing access to the network is important. And if all the miners pull the plug and all the hash rate ends up in China or in Russia or somewhere else, what's to stop, the effective equivalent of a reverse OFAC issue that blocks US citizens and companies from access to the blockchain. So I really see Bitcoin as an imperative. And as we look at the market, power availability is getting tight. You hear about it all the time. All the hyperscalers are talking about it. But beyond that, credible developers and operators are even more scarce. So we're winning power contracts ahead of a company like Microsoft in Cheyenne. Why would Black Hills Electric choose to work with CleanSpark? Certainly our credit risk is not nearly what Microsoft
Sure.
is. But the challenge is I can deploy immersion cooled infrastructure and be hashing and buying those megawatts from the utility and monetizing that power in 6 months or less. And to build a proper data center is going to be, several years. So we can then begin to develop a data center behind it and then duplicate that model, pick up the immersion cooled infrastructure and drop it down at a new location. So, we feel like Bitcoin mining really plows the road for other types of compute. We have, more hash rate domestically than anybody else. We have a top 10 Bitcoin treasury. If you look at bitcointreasuries.net, we mined it all. We didn't buy it. So we didn't lever up and borrow money to buy Bitcoin. We mined Bitcoin at, like I said, greater than a 54% margin. And we've stacked $1.5 billion worth of that Bitcoin. And, to, I guess, the last point in the comment that we talked about dilution, CleanSpark has not had an equity offering in any way, shape, or form, or sold a single share of equity to raise capital in almost a year. It was November of last year. And so we've been very disciplined. My peers put up $1 billion, $2 billion, and then, stack up converts on top of that. So, our approach has been decidedly different. It's been about capital stewardship and operational efficiency. But we're going to get there on the HPC side, the same way we did on the Bitcoin side. And that is, I think that while there are first mover advantages, you see companies, Tyler Page, one of the smartest guys I know, they just put up a deal and they locked in a contract. And if you look at the economics of that contract, the revenue is not decidedly different from what you would get on an S21 immersion. So we think being a last mover and being able to choose the partnership and the relationship after we have the proper team in place is really the appropriate strategy.
Wow. One thing I want to backtrack a little bit. What is, you talked about a reverse OFAC. What is that exactly?
So you think about the fact when Russia invaded Ukraine. So the United States is going to penalize Russia. So we have control of the SWIFT network. So we block Russia from the global financial network, through OFAC sanctions, because we have our finger on the scale of controlling that. When you think about access to the blockchain, now it's decentralized, it's peer-to-peer, it's distributed. However, what is there to assure access to block space for a U.S. company like Saylor or U.S. investors like you and me if there's no domestic hash rate? What's the certainty there? So I think that's a big I think that's a legitimate concern. And, we had conversations on the Hill a week ago and talked about, the fact that we're uniquely positioned because power and land and infrastructure are mission critical for, our country continuing to succeed on the AI landscape. But the only way that you can build that quickly and still be a flexible load and partner with the utility is by having an interruptible component. And so I think we're approaching this, that there's a better balance. We can generate the much greater revenues, but we still secure the blockchain and make sure that there's domestic access to hash rate.
Yeah, thank you so much. I think one thing too, like we're seeing like insane amounts of spends. I don't know if you saw this Trump interview, but he was going around the room and he was asking like all these CEOs, he's like, how much are you going to spend in the US to Meta? And they're like 600 billion. And most of this is like infrastructure into data centers, which you guys are really getting into. And so from like a revenue generation model and how you guys are valued moving out of Bitcoin mining strictly and moving into HPC and AI, how are you thinking about this according to the revenue for the company?
So that's a great question. And I think it's really important to drive home the point that we're going to do both. Okay. But HPC revenue happens with high durable margins over a longer period of time, but CapEx is much higher. So now you have a customer. I don't have a customer with Bitcoin mining. So you need to evaluate tenants very carefully. They need to be managed. You need to have contracts that protect the shareholders as well as the customer. We look to integrate both of these in the future. And so when you say, what's the value per megawatt or per kilowatt hour of energy for an HPC deployment? And the answer is, it depends. And so you think about CleanSpark has well over 100 megawatts in Metro Atlanta. So why is that more valuable than the megawatts we may have in a more rural area? And the answer is latency. I mean, as you look at things like full self-driving and autopilots or, surgical robotics. If there's a lag in a surgery process whereby they're using AI for surgical robotics because of latency, because it's an extra several milliseconds to make the round trip, what's the impact there? So the value of megawatts differs. And so while I have 250 megawatts in Sandersville, Georgia, that makes a ton of sense for Bitcoin mining. It makes a huge impact in the community. It makes less sense for HPC, whereas metro facilities, stuff closer to Nashville, Atlanta, Cheyenne, there's a massive, you could hit driver 9-iron and be on a Microsoft campus from where we are in Cheyenne. So it really is it's geographically dependent, but there's tremendous value. And so our analysis is, what's the greatest value of the megawatts that we control per location that delivers the best return and value to our stakeholders?
That's so interesting. Yeah, this goes into like stranded energy versus like energy that's close to a metropolitan. So you're saying any type of energy center, anything that's close to a metropolitan makes much more sense for how valuable the gigawatt is according to what the company would be, whether HPC AI. But if it goes stranded, it starts to become much more valuable for Bitcoin mining.
Sure. So like a neo cloud, any HPC that's sensitive to time. So again, you think about a millisecond or 2 milliseconds latency on a round trip signal. If that happens to be dictating the full self-driving on your Tesla and there's an accident about to happen, do those milliseconds matter? And I think arguably, yes, they do. So I think our approach is going to be, or has been, build the team first and then make a case-by-case decision about the location of the megawatts. But then, you think about, my friends at Core Scientific, they have a massive facility in Pecos, Texas. So hundreds of megawatts, there's no fiber. So, are they going to convert that at some point to HPC? Absolutely. But then now you've got all the right-of-way issues. You've got to build hundreds of miles of fiber. So I think access to a meet-me intersection point on a fiber network is important. I think geographical diversity is definitely important. And I want to make sure that I'm clear. there may be use cases for neocloud stuff, even on stranded, more remote power, but it might not be the same value per kilowatt hour as running the most efficient S21 or S23 or proto rig. So I think it's a case by case decision basis, and I think we've established that we're pretty good at making the right decisions in the right time. I mean, we're the last kid on the bus and the biggest miner in the country.
Yeah, that's awesome. Wow. Do you guys have any financial milestones for this HPC AI movement over the next 2 to 3 years? Like what you're really aiming for?
Yeah. So specifically, I want to be careful because I don't want to go too far into how we're going to separate those megawatts, but I would say we're laser focused on gigawatts under contract. So that's, I think priority one is power and land, because that is as scarce as it comes. And then the opportunities follow behind that. I mean, Meta is not interested in necessarily going out and developing 20, 30, 50 megawatt sites. They want 500 or 1,000, right? They want a gig. We have the ability that we can deploy in a different capacity and serve those critical IT loads where they're needed. And, we built 33 data centers in 5 years, and I have access to new power every day that gets presented to us just because we've made commitments to the communities and the utilities. We've kept the promises. We pay our bills on time. We buy the power when we say. And yet when a hurricane comes through South Georgia and the infrastructure is damaged, we can curtail. We built substations. We can curtail and redirect power so the lights go back on at the hospital. So being a responsible community partner is more important as a developer than just having a big balance sheet.
There's two side adjacent things I want to ask. Like one, from a sizing perspective, can you talk about scale, like gigawatt, like how, from a scale perspective, like Meta, what they're looking for, how large is this and how much energy is this from like a retail perspective? Is this 1,000 homes, 10,000 homes? Is this 25 Walmarts? Like,
so this is what creates the stories in the New York Times that are fascinating to read, but not based in reality, right? Like the one where they said mining in the state of New York consumes more power than all the residences in the state. Well, the journalist that wrote that article was talking about the power that flowed through the hydro dams. So if you count that as consumed, that's a stretch. So, however, when we raised a $650 million 0% bond in November of last year, led by Cantor. And in those discussions, we had to talk about the fact that at the time we were operating 840 megawatts of power, which was enough power to operate, I think, 220,000 homes.
Got it.
So that's under a gigawatt. So think about, I think if those metrics are accurate, it's about 250,000 homes per gigawatt.
Wow, my gosh. That's crazy. Yeah, and I think, moving into this, for you guys now having HPC AI, moving for gigawatts under contract, how do you guys looking at spend now from an infrastructure standpoint? You said land is the most important, which totally makes sense. Like, especially if land location is extremely important for HPC AI. It seems like maybe being 10 years early to this was probably the linchpin for you in comparison. So how are you deciding where to reinvest profits from an HPC to possibly Bitcoin mining to land, or what are your thoughts around that?
So it's a great question. So we think of it as kind of a three-headed monster.
Okay.
We have $1.5 billion worth of Bitcoin sitting on our balance sheet. And while many treasury companies calculate MNAV by the appreciation of Bitcoin and how subsequently it talks about the amount of Bitcoin per share of stock, we actively monetize our Bitcoin. We just promoted Rory Murray to the vice president of our digital asset management team. But we built an institutional grade digital asset management team. So we're using the Bitcoin on our balance sheet in an environment where there's limited, if any, counterparty risk. And we're able to use derivative instruments to generate greater yield on the Bitcoin that sits on our balance sheet, rather than just, throw $1 billion worth to Galaxy and get your 3% a year like many of the other companies do. So margin expansion is going to be always a focus. So with mining, we can control that by the efficiency of our fleet and making time sensitive decisions on when to mine and when not to mine. We built a technology stack, and we have some of the, I would say, the world's most, probably the brightest thought leaders in the world when it comes to mining operations. Guys like Taylor and Brad and Tyler, they built the tech stack, and it makes decisions in real time whether we're going to overclock, underclock, curtail, or go full blast. We have these decisions that are made based on APIs from the utilities and real-time data as far as the global difficulty and the price of Bitcoin. So, obviously we look at efficiency of operations, and that comes out of our DNA from being a microgrid company, putting power systems on military bases, right? So I think you control the efficiency by the fleet efficiency you have, by the operational prowess that you have, by the ability to secure the right kinds of contracts. But I think we have to understand and acknowledge that the EBITDA on HPC is higher. CapEx is also higher. So, we'll focus on reducing power and mining. And then I never say never, but I think we start to explore potential power generation opportunities, because that's going to be a linchpin. I had the opportunity to open the Imagine If conference in Nashville with Senator Blackburn. And she and I had a long conversation, and the fear is having enough power, and the challenge is, do you overbuild too much power, and then what do you do with it? And then your CapEx is higher, so you've got to have higher utility rates. So the ability to have an interruptible or flexible load that monetizes the megawatts when there's not demand elsewhere, but you can interrupt that load and curtail it and push it back and prioritize it, I think that's all really, really important. So right now, our process is pretty dynamic. I think we want to build a deep Bitcoin balance to power our DAM initiatives, so digital asset management. And we're well on our way to doing that. And then holding Bitcoin, that we have significant margins, allows us to leverage the collateralized lines for growth, which in turn expand production, which expands gross margin. And then rather than put up a $2 billion ATM, we just announced another $200 million in a Bitcoin-backed line of credit, single-digit interest. It's a revolver. So when there's opportunity for M&A or an increase in OpEx, I can tap that line of credit, and we can use the Bitcoin that we're already generating to pay down that line of credit without having to lean into the debt and equity markets. So it's really it's a conscious effort to do that. And so, long-term shareholder value is just, it's a function of earnings, balance sheet enhancement, and most importantly, growth.
Wow. So like something you talked about, you guys have done, you've been opportunistic on timing, and it seemed like you talked about being capital conscious and like really intelligent about it. And so having a line of credit like 200 million in comparison to just getting it and using the accumulation game where you're focusing on that, for you guys, is it more important about timing than it is about like frequency and accumulation speed? Because it feels like, and this is a adjacent one, but it feels like the ecosystem right now is in a mad dash for accumulation speed, irrespective of responsible capital movement. What's your thoughts on that?
No, you're exactly right. I think dilution is just a normal part of capital formation in a business life cycle. It's going to happen in any instance. I think there's a differentiator. So we've raised $3 billion over, since inception. We have a $4.5 billion market value. We're sitting on $1.5 billion worth of Bitcoin. So I think you could argue that strategy has been accretive. It's not always popular. And when you're focused only on Bitcoin mining, investors are pretty savvy, and they look at the ROI on a Bitcoin miner and the depreciation and the OpEx that goes along with that, and they start to question it. And what ultimately happens is a good Bitcoin miner that can mine consistently at a margin is going to trade more like a utility. There's no enthusiasm, there's no speculation. If we had stood pat and said we're going to only be America's Bitcoin miner, and we're going to grow this year from 50 to 65 exahash, there's no risk not to short the stock, because you can set your watch by the price of Bitcoin and the price of power and seasonal interruptions. And so now there's really nothing exciting. There's no potential. So I think to think about it a little bit differently and use capital strategically, what you're going to see first from us is we're going to talk about the way that we build our team on everything we've done. we started out as an energy company, and we partnered with 2 research universities to build a portfolio of technologies on baseload energy generation. We then evolved into a microgrid company, and we bought arguably the most advanced microgrid technology company on the planet to partner with, and brought that team of people in that had deployed microgrid technology around the world. When we shifted into Bitcoin mining, the first hire I made was a guy named Bernardo Schuckman. Bernardo Schuckman is an OGE Bitcoin miner. In fact, when we put a transaction together, I got an independent audit from BDO that Bernardo had mined more than 50,000 Bitcoin over the course of his career.
Wow.
Personally.
Oh my gosh.
Then we build a full scale immersion facility, and we go steal Taylor Monig from TMG Core in Dallas. They were building, CIA, NSA level data centers with, liquid to chip cooling and 2-phase cooling. So when we decide we're going to start Bitcoin mining in an immersion cooled environment, we didn't just guess. We got the best in the world. So we've accumulated a team of people that are the best of the best of the best. And I think it would be an insult to our shareholders to say all of these really smart Bitcoin people are now really smart HPC AI people. So I think what you're going to see, crawl, walk, run, just like with our digital asset management, just with our mining, you're going to see the team kind of gel first, and then you're going to learn about what our strategy for expansion is and how we choose to monetize those megawatts differently. So I think it's going to be very disciplined, but we went from the last kid on the bus that kind of got made fun of that we were too late to Bitcoin mining to, now having more hash rate in the US than anybody else. And I think we were opportunistic about that. And you'll see that a lot of these early contracts where Bitcoin miners are more chasing just a name brand as a counterparty on a contract, they're leaving an awful lot of value on the table. And I think being strategic about it is much better than being fast.
Wow, interesting. And I think that's something that's cool about this too, is this is really backed up. You're one of the highest uptime, if not the highest uptime miners. So you really feel like talent is playing a lot into the equation instead of like this mad dash towards whatever it may be. If we all believe numbers going to go up, then accumulation becomes this like really perceivable thought process for everybody. But for you, a little bit slower with the right people.
Yeah, I think you have to do that. You look at some of the other large scale miners, they've taken on billions of dollars in debt to develop a treasury strategy. Well, you look at the Qs and Ks, and if it costs you $165,000 to mine a Bitcoin, your capital is better spent buying Bitcoin at spot, because otherwise it's a losing venture. We focus on maximizing our uptime, minimizing our energy exposure, and getting the most efficiency out of our fleet all the time. So I can make more for less than most of my peers can. And by being disciplined about that, selling a portion of our new production to pay for our OPEX rather than living on dilution and debt, we're building a balance sheet slower. But my balance sheet of Bitcoin, we started to hodl 100% back when Bitcoin was bottomed out in that middle of the last cycle at 15,000. So we were stacking Bitcoin profitably in that $15,000 to $18,000 range, and we've continued to do so. Only recently have we shifted, and now we sell a portion of our production to cover OPEX. We're not selling a portion of our hodl because, I mean, if there's 1,000 Bitcoin in there that we mined at 20,000, the tax impact to sell that, to fund a transaction, to buy it back, those are sats I'll never recover. So the 200 million that I talked about is an expansion of a credit line. So it puts us up to $500 million. But to use the Bitcoin as security to borrow that money, I don't have to sell it. I don't have the tax impact, so I can do it in a much more disciplined manner than many of our peers can. And so that really comes down to, again, and you probably get sick of hearing it, but capital stewardship and operational excellence. That's really where we see that we live, and understanding energy better than anybody else in our space, I think is a distinct advantage.
I think for right now, from a shareholder perspective, how are you guys thinking about reinvestment in comparison to buybacks?
So I think we prioritize optionality. So our management team's always focused on building long-term shareholder value. So would it make sense to sell part of our HODL today to do a buyback or to pay a Bitcoin denominated dividend? We've had these conversations. I love the idea of paying a dividend. I think that cures a lot of the short seller issues in a big hurry. The challenge is if we distribute some Bitcoin, or if we borrow money against an ATM to did I lose you,
here.
Charles? I don't see you on here.
2 seconds. Let me turn this camera back on. I can hear you though.
Okay. I think that it looks like a brilliant move if you do it and Bitcoin stays flat. But if you sell some of a stack of 13,000 Bitcoin and Bitcoin goes to 250,000 or 300,000, now all of a sudden you were premature and you made the wrong move. So I think disciplined treasury management, disciplined capital management ultimately results in long-term shareholder value through share price appreciation rather than trying to get cute with paying a dividend to catch the shorts. I think we're a little more pragmatic with our approach. I'm not saying it won't happen. We've had some spirited discussions about it, and I think that would be a huge differentiator. But I think for right now, securing power and land is priority one, and I think ultimately the long-term value, share price. Short term, it's a voting machine. Long term, it's a weighing machine, right? So I think we have to take a long term approach, and we've made some changes in our organization. I think that the market cap's up a couple of $2 billion in the last 60 days, and I think you're going to see that continue.
For a lot of this debt accumulation, the narrative has to be, and this is a side adjacent thing I'm thinking of, but it seems like the narrative that you have to sell, like even Tom Lee, and I'm not trying to speak against anybody, but his narrative right now is that we're in a super cycle, which makes really fast accumulation make sense, but maybe not as the most balanced in perspective if things don't end up going. Nobody has a future teller. So it seems like you guys are taking like, hey, let's not imagine the most rose-colored scenario in the entire world and just play an accumulation game, but let's be much more measured in our approach.
Well, Tom Lee thinks like an ether guy too, right? I mean, I think what we can acknowledge is that there will be 21 million Bitcoin, and that's all. So I think scarcity, just like on land and power, scarcity on Bitcoin is a driving force. So while accumulation is definitely happening, I mean, look, the IBIT ETF, the $50 billion in value in 55 days or whatever it was, 105 days.
It's insane.
Yeah. I mean, the second fastest was a number of years slower. So you think about the fact that we control 5.5 or 6% of the global hash rate. CleanSpark does. We make 22, 23, 20 Bitcoin a day, depending on difficulty and temperature. And there are only 450 Bitcoin a day, and that gets cut in half again in May of 28. Scarcity and accumulation is one thing, but day one of Econ 101, supply and demand is the overarching strategy here. So I think there are so many derivative instruments, and there are a lot of paper Bitcoin that people are trading derivatives around, that I think as price appreciates, you have to settle a lot of those trades. And that's when I think you realize how scarcity really is an issue. And I think we could see a parabolic run in the price of Bitcoin.
It kind of seemed that way. I mean, so another question, how do you ensure the company doesn't repeat mistakes we've seen with other miners where treasury mismanagement hurts shareholder value? I think you've talked about this a lot, to be honest, by being very measured in the approach, but I'm interested and curious to your thoughts.
So I think to get through all the questions,
no,
so
you're fine.
Continue to be so long-winded. I think it really comes back to my earlier point around controlled leverage and cost control. I think fundamentally the way we look at it is Bitcoin's a long-term strategic asset that is still very early in the adoption curve. So there's going to be volatility along the way. We've seen it in the past, but I think provable digital scarcity and transaction settlement finality powered by breakthrough technology generates a total addressable market that nobody's considered before. So I think it's about control and
this is
discipline.
a side note adjacent, but the economics for Bitcoin, like Bitcoin has to go up X amount for it to make sense as we go into the next cycle and go into when block rewards half again. For you guys, like this is a side note, but as China is like booming on power, and that's really your background is power, do you think like a booming power infrastructure play is going to be the backbone of Bitcoin to reduce power prices? Because I feel like a lot of the narrative and what people are talking about is Bitcoin has to appreciate in price for this to make sense for miners. But are you guys thinking about this from a power perspective? Like, actually, if you just reduce the price of power in half, you're in just as good of a situation. And if Bitcoin booms while you reduce price production, you're actually producing a Bitcoin for way cheaper than everybody else that's just focusing on accumulation.
Yes.
Okay.
The simple answer is yes. So let's I want to have a conversation that's just hypothetical. This is in no way investment advice or any part of CleanSpark's current plans. This is a hypothetical discussion that you and I are having. We know that we need hundreds or thousands of gigawatts to support the AI expansion. We also know that there's not current demand for that it's going to be scaled over time. So the way that I look at energy in Bitcoin is that a domestic Bitcoin miner will partner with utilities and put a 6 megawatt immersion pod behind the fence at every power plant or substation. And when there's surplus power, the utility makes the decision to energize mining. The miner operates that. So the utility's contribution is the surplus power that would otherwise go to ground, because we can both acknowledge you can't store it. You generate it unless you have a battery, that power is wasted. So I think zero cost power, partnering with a utility with daily settlement. So your utility in Cheyenne, Wyoming has an account and they get a scrape off the pool every single day when the awards are placed. They contribute power. A miner that has pretty good efficiency and uptime contributes to the mining infrastructure. And so now you have multiple deployments of low maintenance immersion cooled technology spread all around the country, stabilizing and securing the blockchain and monetizing stranded megawatts as part of the global expansion of
This
power.
How you reduce the price of electricity. Wow, super smart.
Goes to
I
zero.
was talking with Adam from Upstream Data, and they're doing a lot of this with power companies as well, where they're coming in. And I don't know a lot about this world, so I'd love to get your take on it. But if a power company has to burn off a certain amount of power, they have to actually pay for that burning because it's the environmental impact. I believe that's the case. And so if the play for you guys coming in is like, hey, you're paying literally for the stranded energy that you have, we will take it from you. You no longer have to pay anything, and they're actually saving money and you're able to use the power for free. Is this what we're talking about?
Exactly what we're talking about. We're talking about strand. So you look at the duck curve on a solar chart, right? So sun comes up, everybody's at work. There's not that much demand. Sun goes down, people come home, turn on power. So now you've got this weird imbalance on the grid. So the challenge is that as we put more renewable energy on, you can't tell the sun when to shine or the wind when to blow. Now, what you're talking about has a lot to do with flaring, right? So if you have a power plant and you're now flaring gas rather than spinning a turbine, there's an environmental penalty for doing so. So I think when you put all that together, now we've got temperature trends and severe weather and storms, and the grid. Part of the challenge is that if everybody in the jurisdiction turns on their oven and their lights at the same time, the grid has to serve that load. So you have to have that capacity. So what we've done historically to compensate for that is we built peaker plants. So you have 5, 10, 20 megawatts of coal sitting in the background because you can't throttle nuclear. It's on, it's up. The sun is fixed, right? So what you have flexibility on is gas and coal. But if you're running a turbine and you end up flaring gas, now it's an environmental penalty. So you have these standby coal-fired power plants as peaker plants that when there's that demand, you're now shoveling coal into a furnace or blasting it into
Wow.
a turbine. So now you've got this additional expense. A better way to do it is to create a stable demand that's flexible. So you have Bitcoin mining as a partner to a utility, and when demand spikes elsewhere, you can rapidly curtail that. When Hurricane Helene hit Washington, Georgia, and the city's substation went down, we were able to curtail our power and redirect our substation back to support the hospital within an hour. So when you talk about flexibility, you couldn't spool up a coal-fired power plant and generate the load that fast. So it really is a tool for the grid. And I think, we made a lot of progress on Capitol Hill, spending time with Senator Moreno and Senator Haggerty, talking about the value that Bitcoin mining provides far beyond just as in support of the blockchain. So there's a much more creative way to do this, and I think you're going to see that.
I can totally see this. Do you think for you guys, and going back like a little bit, as you start to branch out into HPC, you said this is three things, three-legged. Let me turn this back on real quick. You said this is three legs of a total vision, which is HPC, Bitcoin mining, and then you also have the Treasury play. For you guys, do you feel like shareholders or retail is looking at you like a Bitcoin proxy play? Do you feel like they're looking at you like a miner, now like a technology company in general, or are you kind of looking at like this at all three?
I think right now we're 81% institutionally held. So I think retail looks at us like a redheaded stepchild they don't really like. And it, it's probably fair because the enthusiasm and excitement, the idea of maximizing the value per megawatt is something that we were a little bit slower to arrive. But I think the timing is actually perfect. So I think, you look at a Digital Realty and they have far fewer megawatts than CleanSpark. And yet they're valued at a significant premium a value of a megawatt on Digital Realty's balance sheet is 1,000x the value of a megawatt on CleanSpark's balance sheet. So it really comes down to a communications issue, and it's about deploying the proper strategy, but not just saying, hey, I'm going to plug in a bunch of GPUs and someday I'll have a customer. That's the wrong strategy because investors today are far too sophisticated. So I think we have to take a disciplined approach, and that's where I kind of was headed with building the right team and then making the proper analysis on the locations and the megawatts. And then you get valued really based on the entire portfolio. Based on your mining operation, I mean, we're at $800 million a year run rate at a 50% gross margin, 54% gross margin. That's a hell of a business when you consider our top line revenue in 2019 was less than $10 million. The problem is that the narrative comes out, it's a dilution machine. So, we pay for the sins of our entire industry, even though we haven't had an equity offering in a year. We're still kind of painted with that same brush. So I think the market really doesn't know how to look at us. I mean, you look at the wild shift in valuation from all the sell side analysts that cover the space. Some guys say $12 and some guys say 40. They have these differing models that, they contemplate a number of variables. And I think we need to continue to demonstrate our operational prowess, not just in Bitcoin mining, not just in responsible treasury management, but I think what you'll see from us from the standpoint of compute is an industry standard setting as far as efficiency. Everything is measured in 5 nines when you talk about that. So how can you have resiliency to the 5th decimal point if you don't have the right kind of power contracts? So, you're in West Texas on ERCOT on an interruptible load, and you're trying to attract a customer that requires that redundancy and resiliency. And you can't have that certainty unless you build generation. So then you build your own generation, and now you've got even bigger CapEx. So you look at the ROI on the CapEx plus the infrastructure plus the rapid, look, you think the ASIC market is a rapid refresh cycle. Just listen to
That is
Jensen
true.
Huang talk about, once they started shipping Blackwells, they couldn't give hoppers away. So, that refresh cycle is even greater. So I think there's a lot of creativity that's going to
Yep.
come in to support the demands that we have. And what we're learning is, he who holds the power and the land really holds the keys to the kingdom. And so having taken a distributed approach and being in multiple states and soon to expand into another, I think you're going to see that we get appropriately valued per megawatt.
I think one thing,
sooner
this is a
rather
side
than later.
addendum, but I was thinking about that's super smart. Like a lot of other mining companies went international with the operations from an expense approach because maybe they could get it cheaper. And we saw issues with Paraguay, like the government came in and just stole the miners, stole the operations. For you guys to pivot into HPC and AI, but then have everything in country, is that making it a lot easier to have those conversations because you're already prepared with the infrastructure? Because I feel like for other players going international and then being like, oh, let me pivot to HPC, but I've never had US relationships, contracts, power infrastructure, you're actually kind of a little bit behind the ball than what you guys decided to do. Is that how you're feeling about it? Or
1,000%. And, quite frankly, you talked about Trump talking about how many billions is Meta going to invest in infrastructure. And what did he get Tim Cook to commit to, to build to build phones domestically? The way we look at it is, if I have power and land and infrastructure and we can onshore a lot of the operations that have been pushed offshore, at least for the next 3 years, we become a darling for the administration and we become the standard bearer. The problem historically with our industry of Bitcoin mining is that, you get a narrative that it uses more power than all the homes in New York, or it consumes more water, or it's irresponsible use of energy. Well, would you rather, to our earlier point in the conversation, would you rather be flaring that gas or running the power to ground? Or would you rather monetize it for the benefit of the community? And, we've taken this approach that, they did a story on the TV station in Atlanta that this big bad Bitcoin miner comes in and they're buying all this power. Well, it's in a rural Georgia community that 4 decades ago, there was textile manufacturing. And all that gets offshored. So now there's power that's a distance away from a major metropolitan area that's just stranded. Now, the citizens of the community, they all invested in the muni bonds to pay for the generation and the distribution, but now it doesn't get consumed. So we move in there and we buy the power. So in order not to put the city in a financial burden, we pay them their cost for power because it varies, right? So we make sure that we cover their cost and then we give them a margin on every kilowatt that we buy. So now the city's never going to lose money. We don't put somebody in a position where it's fixed price. If you can't deliver it at 4 cents, I'm going to take it anyway and you cover the difference, because these little communities are the utility. So now that's how you become wildly unpopular, is putting a burden on the balance of the ratepayers. So our model is different. We buy the power at cost plus a margin. The city's always going to make money. What does that do? It enables the city to commit to generation to buy more power at a lower price. So it decreases the exposure to the ratepayer. Those margins then stay in the community. So schools and bike paths and splash pads and hiking trails, that's where that goes. Well, then there's another level. And this is what was on the news. Sales tax on utilities in most communities stays in the jurisdiction it was generated. So we had an interview with the mayor of this little town, and he's been in public service for 47 years. He said in 45 years in public service, 47 years in public service, 45 years, they closed each fiscal year with a deficiency. Since CleanSpark has been there, they had a surplus, and the sales tax created such a surplus in these communities that they had to spend it. So they applied it to all the property tax. So now the terrible Bitcoin miner comes in, buys power, lowers your rates, puts money back in the community, and the sales tax on top of that lowers your exposure to property taxes. So now, instead of me going knocking on doors in communities saying, hey, can I buy your power? The inverse of that is true. We have people calling us saying, what do we have to do to get CleanSpark to come to our community? Which, as you talk about that global exposure, Now I'm not trying to re-onshore assets that I'm going to face tariffs because of their origin. I've already got all my assets here. Now I'm just expanding and leveraging the relationships that we built by keeping promises.
Yeah, I think one thing too, you touched on this before, but now with MNAV coming out for every company that holds any type of digital asset, like how are you thinking about how to poise yourselves to the shareholders? Because you're seeing this weird, even like novel understanding of what values the company and novel metrics popping out. Like, how do you communicate yourself to a retail shareholder to make this all make sense? Because you talked about like gigawatts under contract, extremely important, which is the traditional look. Like, new contract comes out, stock goes up 15% or whatever it may be. How do you guys look at yourselves holistically and communicate that?
I think what has to happen is that we get assigned a higher multiple compared to HPC AI peers rather than mining only. And I think that becomes a comms challenge to make sure we talk about the fact that, we see the multiple divergence in our industry between mining and HPC, and ultimately it comes down to our power portfolio being fully understood. So if we deliver on both compute use cases and build the strongest long-term business that we're able to, that becomes a differentiator. So now it's not valued as a pure play Bitcoin miner, but it's also not digital realty. So there's some balance in the middle. And I think when it comes to MNAV, nobody heard that
brand
term
new.
24
They made it up,
right? So I think exactly. So I think what we look at is the actual ROI from our digital asset management desk. Just like if you were managing a fund, how does the fund manager do with $1.5 billion? How can they moderate risk and maximize income off of that? And I think it becomes a function of ROI rather than MNAV for a company like us. So when you take that efficient Bitcoin mining, $800 million run rate in Bitcoin, plus a responsible straddle, I don't want to call it a pivot, into other types of compute, I think you get a premium rather than a penalty. And right now we're trading at a massive
just looking at the
discount.
comparison. You guys are almost the best discount in comparison to everybody. You have the highest uptime, which was crazy. I was talking to a buddy of mine, and he was like, I think CleanSpark is the next really big move because you guys are trading at such a discount in comparison to usable megawatts and gigawatts in comparison to everybody else.
Fox Business News last week did a segment where they had stock pickers on. I posted it on my Twitter. If you want to go look at it, there's a link to the video. But they said CleanSpark is the cheapest of all the Bitcoin miners and has this AI portfolio of sites that are undervalued. So I think you're right. I look at some of our peers and the valuations that they have. And I don't dispute them. I think, the Roberts brothers at Iron have done a great job, but Iron has 50 exahash, which is the same as CleanSpark, and has no Bitcoin on their balance sheet. And they've developed a campus. They have a portfolio of energy, but what they're building is 50 megawatts of critical IT. Iron is worth more than CleanSpark with 50 exahash and 13,000 Bitcoin on our balance sheet, plus Marathon with 70 exahash of global capacity and I don't know how many tens of thousands of Bitcoin they have. So there's this massive disconnect that we're being penalized as a Bitcoin miner, but we're getting no upside. And so I think when you start to see customer agreements that are meaningful, TeraWolf just put up a great deal. Like I mentioned, Tyler Page at Cypher, they did a great deal. I think there's a ton of excitement, but I think it has to be moderated. I think the CapEx risk to being, an AI hosting facility where you buy the GPUs, I think that's a challenging CapEx cycle. You want to talk about dilution now. Reggie Smith, who's the analyst at JP Morgan, made a revision to his note talking about Iron, and he said that he actually reduced them to hold, I think. But if you read his note, he talked about the fact that in order to get to where they say they're going to be, there's $26 billion in CapEx. And I'm just paraphrasing. It may not be 26, it may be 24. Yeah, but the point is the CapEx lift is massive. So I think you have to, the old saying, right? How do you eat an elephant? So I think you're going to see us take a really disciplined approach to that. And we'll message that over I think the next 2 weeks, we'll start to kind of flesh out the story on where we're going. And then you'll see a lot more detail about
thank you so much.
deployment.
We're just at this final 2 minutes. I really appreciate your time, Matt. Like, this is genuinely awesome. And a lot of times for the creator ecosystem, what's interesting is we'll do content with other creators, but to hear from people in the industry, especially you, like, changing from originally, you talked about how people had narrative, like we're just a small power company, and then doing it successfully through talent each time. It's just cool to hear from people in the industry. So thank you so much for your time, and everybody listening. This is Matt Schultz from CleanSpark. And do you have any thoughts before we jump off?
No, I just everybody that said we're undervalued.
No, he was.
I need to connect with him on Twitter because we're drinking the same Kool-Aid.
Anyway, guys, thank you so much. This was Matt Schultz. Matt, thank you so much for your time. Truly appreciate it, and we will connect again. You got it.
Yeah, let's do it again sometime. Thanks, Charles.